Hello, welcome to the Stockout. This is your show on FreightWaves for all things related to the CPG and retail industry. I think this is going to be a second show in a row. We focus more on the retail industry than the CPG industry, but we'll try to make up for that next week. I'll find some good CPG stories. Grace, good to see you. Did you do any Black Friday shopping this time?
I took my dad Black Friday shopping for myself, so you could say in a way, lightly, I did. I took a couple of deals I took advantage of. Definitely bought some stuff for my parents with a nice little discount, and we'll actually get to this, but I bought a few items that just were just great deals and had nothing to do with any gifts at all. So I think a lot of people took advantage of that too.
Yeah, same thing here. I got myself a new gym membership, the one I was going to close down, which actually a lot of them have closed down. That's why I kind of think people are not renewing their gym memberships. But that was just a good deal, and had nothing to do with a gift or anything. But it seems like there were a lot of discounts competing for your dollars. So it kind of goes into our first topic here, which I was reading through a number of articles yesterday on Black Friday, and it sort of paints this mixed picture of consumer health. And I mean, we talk a lot about this on various FreightWaves shows, how's the consumer doing? But there's some that kind of give you a picture in kind of real time, like MasterCard. They have the spending pulse, and it says it's retail sales on Black Friday grew 2.5% from last year. They said in-store grew 1%, online grew about 8%. You mentioned that the NRF, National Retail Federation, was expecting like a 3 to 4% growth overall. So maybe a little bit below that. But then there was this other source, Adobe Analytics, was saying that Black Friday was up 7.5% from last year. So, I don't think either of those really see anything. So I think it's maybe safe to say kind of growth in the mid single digits. And if that was the only thing you could have to look at, you would think the consumer was doing just fine. I mean, even though it's not adjusted for inflation, not really clear what impact inflation is having on some of these deals. I mean, it seems like maybe there were such deals that there was actually deflations in some of these categories. Some of what Walmart was talking about was kind of deflation. So if you look strictly at that, you would think that the consumer is really healthy. And I think the counterpoint to that is that consumers are clearly putting more on credit cards. You have that Sonar chart, the revolving credit outstanding, which, for a long time it keeps rising, and now it's maybe starting to settle in up there at almost 1.3 trillion. That's total revolving credit. Credit cards are a little over $1 billion of that, but that little flattening out, I think, suggests consumers are maybe getting a little bit tapped out, like we'll see in a couple slides here. But credit card balances rose 1.6% October from September, month over month. So that's versus 0.7%, which is seasonally normal. And there's been an increase in charge-offs as well. And so you have all those things. And then on top of that, you've had, growth in the buy now, pay later schemes, which is 7.6% of the online, shopping now. And you want to go to the next chart on this utilization rate. So this is the thing. I mean, I would say that, you have the credit card balances have risen, and, some people would say, well, they really haven't risen as fast as inflation has. They have another chart on that shows, the credit card balance is not rising as fast as inflation. So the total credit card balance is in blue. This is from the Federal Reserve of Boston. So in absolute dollars in blue, you see that hitting new records. If you adjust it for 2015 levels, it's still well below, let's say, the pre-pandemic, levels. But if you go back to that previous chart, is maybe the one that I think is maybe more interesting, which is showing that these utilization rates, so these are credit card balances relative to how much, credit availability there is. Those are up almost across the board, and in most cases above pre-pandemic levels. And then you look at the ones that are in that less than $75,000 range, and particularly the $50,000 to $75,000 range. These are credit card balances are over 30 days due. More than 80% of them are more than 80% are is what the credit availability there is being used. So if it's if it's 100,000, which probably wouldn't be, there'd be, you have 80,000 of credit. So you get the idea. Consumers are getting close to maxed out, and then so it's kind of this point counterpoint of, on the surface, retail sales are strong. Beneath the surface, there's some shaky things, and then you bring up some good points about buy now, pay later. How would you summarize that?
Yeah, well, what I think is interesting, I do want to point out is looking at that last slide in particular, and just seeing even the over 100,000 is close to 70% of their credit limit being used. I think is it's just kind of shocking overall. We've seen this the almost normal trends of what we see, more of the 25,000 to up to 50,000 households, but to even see the 100,000 plus getting that close to, I mean, 70% pretty much of their limit, I think is pretty shocking. Like you said, right? Overall, we saw retail sales over the holiday weekend higher, right, than we've seen in the past, but bringing up the buy now, pay later type of way of paying, I guess you could say. I think what we're seeing is most Americans trying to push off what they're spending now into the next year. And even more so, then you get into, of course, the charge offs, which is rising. And so that's what I was interested, okay, as we have more of these buy now, pay laters that came out just a few years ago. I mean, their charge off rates are getting just pretty much about the same now as what we're seeing on credit cards, which averaged around 2.38%. I believe that's figures from last year. Now in 2021, they're at 2.39%. So pretty much at the same average as credit card, which is not good because it's not supposed to be used like a credit card, and actually can, depending on how many you have and how you used it in the past, can actually hurt your credit score more than even the credit card delinquencies as well. And I believe, yeah, the CFPB had found at least last year that 10.5% of all customers using the buy now, pay laters were charged at least one late fee. And if that was last year, I can't imagine what that rate will actually be this year when they report on that too. So it's quite concerning, I think, for me to kind of see this and see how many of these type of companies are out there now. I mean, you have Affirm, the name ones off the top of my head, Affirm, Klarna, Afterpay. There's Zip now, right? You can do through your Apple Card. But the positive thing, if you want to find kind of a positive out of the buy now, pay laters, that is going to actually boost a little more online e-commerce sales, because most of these cards or accounts you can't use in store. They're going to be online. So when we see probably a higher rate of e-commerce or online purchases, what also makes me nervous as well as that day, because there's a large majority of people trying to find a way to pay for these items, but again, pay later. So it is. I think it's going to be pretty interesting for us to watch the credit card utilization as time goes by, because I can just imagine if we're seeing more and more of those groups get higher into the new year, well, we can just imagine what's happening in the buy now, pay later space as well.
So what are the penalties like if someone doesn't pay when they're supposed to pay?
So I believe that there's like a heavy fee that you pay, because unlike credit cards, there is no technical interest rate. So I imagine what they make most of their money off of is when you do miss a payment, you, of course, have to pay a high penalty. What I find interesting is, at least the one that I've used in the past, is you can't connect your credit card to it. A couple of years ago, I think they changed this. When a lot of these first came out, you could use a credit card, and there was a lot of reports of people paying off their fees on credit cards, which is just like a wonderful circle of debt, if you want to think of it that way. But now you have to attach it to a debit account. So again, what also makes me nervous is if we say a higher charge-off rate with these type of loans, well, they're collecting these straight from bank accounts. If they haven't either shut down their account to begin with, or called their banks and said, "Hey, don't let this charge go through," which I'm sure you know is not good when it comes to your overall credit score, and
Mhm.
clearly what you look like as a consumer when it comes time to purchase a home or open up another line of credit that you might actually need for something that's less important than maybe some holiday gift that you bought. So I think what makes me nervous is how some of these are set up and really connected to your liquid income, and more so just the chargebacks. If we're seeing credit card delinquencies is high, I'm just going to assume that we're probably seeing the same trends on the buy now pay later side as well.
Yeah, it's still a topic I'm learning about. And I mean, what's interesting to me is I do wonder, and maybe you know this, the buy now, pay later, you can't put it on a credit card. Is that because the Klarnas in the world don't want to pay the fees to the credit card companies? Or is it because the credit card companies view those buy now, pay later as competitors to themselves?
Good question. I mean, that I'm not 100% sure of. I mean, for it's kind of like with I look at it more of like almost you're taking a loan off on a loan, right? Like you, at least I couldn't pay my uh, car payment at the time with my credit card, right? I had to tie that directly to my bank. So I'm not sure if it's a risk assessment situation or something along those lines. It could also be the competition side of it as well. But I think for them, it's more of, I would assume maybe being closer to the consumer's actual liquid funds.
Yeah. So in any event, it seems like the consumer data here very mixed. People are on very different tracks. Seems like people that had a lot of cushion, before all the inflation the last couple of years, still kind of spending what they normally would have spent. They're maybe just saving a little bit less. That's why you've seen savings rates go down. Um, but really, people really haven't adjusted their lifestyle if they don't have to. But at the same time, people that were just kind of close to living paycheck to paycheck already, really getting closer to being maxed out. I mean, my concern would be that eventually you have recession and then the job market isn't so great. People lose their jobs. Well, then people are in a lot of trouble. That causes a lot of defaults and those things. We did hear from some of the retailers last week. One of the things that stood out to me, and I think one of the themes was that a lot of the retailers said that they're not having trouble finding people. They're not expecting a lot of labor inflation. Was it Walmart that said they were overstaffed? And I think Home Depot said that
Depot, yeah.
they're not concerned about attrition anymore either. So
Yeah.
a lot of those big employers seem like they have enough people. So I don't know how much longer the rising wages can help out people that might have credit card debt. But
Yeah, the one thing I maybe assume is that we'll see a lot of people file their taxes as early as possible. And
Mhm.
so maybe some of that will get paid off right into the new year.
It's a good point. Want to move on to a chart that I think is kind of interesting. I mean, I think another topic is inventory levels, and there's been some debate about this whether inventory levels have been really truly right sized. So in the white line here is a retail inventory to sales ratio, and if you just looked at this, you would say inventory levels are at a low level. I think a lot of retailers would say they're kind of in line. I think others would say it's kind of mixed by category, where some of the discretionary items are still a little bit high. I think things like furniture, apparel, still a little high, but this has come down from sort of the historic levels. I think there's been some shifting where a lot of the retailers are focused in on the items that tend to move really quickly during the holiday season, like I think it was Best Buy, so they have lower overall inventory, but more video game consoles. That's kind of similar to what a lot of other people are saying. And it comes to me, it's interesting economic tidbits is existing home sales down about 15% year over year, and that makes a lot of sense with the higher interest rates and kind of worst time possible to buy a home. But with that, people are not setting aside enough as much money for the home purchase and for transfer taxes and for retail sales of furniture. Retail sales of furniture is down about 12% year over year. And so even though these inventory levels are below what we're sort of accustomed to, I really haven't heard anything about stockouts or items being hard to find. Have you?
No, if anything, I think we go back to what Walmart and a number of companies, retailers had said in their earnings that they're looking to take advantage even more so of some of these discounts. If anything, that's what like I said, when I went out and shopped, there was a number of things that I was like overly surprised at kind of what the product was and what the deal was. I mean, I brought this up lightly on FreightWaves now, but I think I was at Walgreens and they had like one of this like box set of razors with like shaving cream and like shaving lotion for like $10. And I was like, well, that's a steal, like any time of the year. And so I just wonder if we're going to see some more of these deals that are getting some of this inventory off the shelves of some items that aren't usually on sale or promoted the way they are. When it comes to furniture, it's interesting. That's actually what I bought quite a lot of this weekend for a number of my relatives. And
Mhm.
personally went to Wayfair and a number of sites and found that there's really some great deals out there for anyone who just want a home looking for stuff. There's something that you can sure get off of one of those sites in particular for a really great price. And I think we'll continue to see that going into. I went to a couple stores this weekend. I noticed that if anything, maybe some of those large items they've kept in their warehouses, that they're not in store. So if clearly if you want to buy them, it's like you have to get them shipped to you. So I take that as well as that having them in store isn't really advantageous towards getting them off their quote unquote shelves or total inventory. So yeah, nothing that I was looking for wasn't there. Even some of the really great deals, you would think, okay, those would be gone in the first couple hours. No, a lot of that stuff was still available.
Yeah, so I think in some cases, I mean, I think some companies have been too quick to say inventories are in good shape. I think that's not true across the board. I think there's still some pockets where it's rising, and I think all things being equal, you would expect inventory levels to be rising because there's so much inventory being placed closer to consumers. So Amazon just
Exactly.
went from having its marketplace sellers, which represents 60% of Amazon sales, go from a national distribution model to a regional distribution model. So now there's 8 regions, and all you have to participate in this in order to qualify for Amazon Prime. And so the products really do need to be closer to the consumers, and so that's going to mean that there's more inventory overall in the system. At least if you want to participate in Amazon, I assume others are going to do that as well. So a lot of those things to keep in mind on inventories, which is so critical in determining freight demand when eventually there's restocking. I want to move on to Donnie Gilbert's write up. So Donnie, I guess, is background similar to yours in brokerage industry. So you might be able to explain this better than I currently understand it. So he wrote up a blurb on Sunday. So on Sunday we published this weeks ahead outlook. Go through various sectors. I do the intermodal section. Donnie does the shipper section. So the shipper section, he talks about tender rejections still being under 4%. For if you look at just dry van, it's really closer to 3%. So really low tender rejections. There's no significant capacity deterioration right now in this sort of strong season. No notable pickup in the spot market activity yet. Possibly there is, a little bit closer, but he also brings up some interesting sort of tidbits. Sort of rejection rates and spot rates historically tend to rise about December 15th. So that tends to be maybe panic mode. He says that capacity comes more out of the market as the month of December progresses. So I guess that's because drivers at some point say, okay, I'm done for the year. And if you're not motivated, maybe it's the first week of December. If you're highly motivated, maybe that's, the day before Christmas, but capacity gets tighter. And then, along with that, there's more and more items need to be, sort of expedited, at least on parcels side, that the busiest day tends to be December 20th or 21st. But all those things, at least so far, he's not seeing any spot rate, spot activity improve. And then if you look at this chart we have on the spread between spot and contract rates, that's still at a really high level. Where overall the
Mhm.
contract rates 61 cents below the spot rates, and so that suggests at least something's not sustainable. Most likely that I guess we've talked about this in the past. I mean, the spot rate's probably not going to go much lower because of the carrier's costs. Contract rates likely to fall further to catch up a little bit. A lot of the bids are coming in now. Extend through the first quarter. So not a lot of evidence of much changing in the truckload space. And with your background in brokerage, wanted to hear your thoughts on. You think that spread, is related to the broker, more proliferation of the brokers, more brokers taking a larger share of the capacity, and that sort of represents the broker spread, or how do you interpret that, given your background?
Well, I do agree with him that that we're going to see that rise in spot rates closer to December 15th. That's when people are going to really start, like you said, expedited shipments in particular are going to become big. So I think carriers just in general start charging more, knowing that, and knowing capacity is coming off of normal numbers. One, you're right. A lot of people are going to go home for the holidays. I mean, to be honest with you, depending on where you run regionally, you'll see a lot of carriers between Christmas and even honestly into January, knowing how awful the market usually is during that time, and also service disruptions into the truck. I mean, you're hitting a bunch of winter weather. There's chances that you have that your truck won't start in the morning, that you'll have slowdowns, that you'll have delays, which we all know all of those words mean loss of profit revenue in general for a carrier, and in a market we're seeing today, and especially how this year we've seen carriers just overly diligent in watching their cost. I think they're going to be even more risk sensitive going into this season in particular. I mean, the last thing you need is that for a trailer to not start in a market, be down because of the weather, be down for a few days, and then you're out that revenue, out that profit in particular. So, but still, of course, paying for the driver to be wherever he's at. So that becomes key. So weather conditions is huge. I'm very interested in seeing even what we see from the LTL market during times where, of course, you need things delivered before Christmas. You'll see more, I think, of these last mile providers being key to that supply chain compared to risking it on an LTL service. I know for a fact I used to promote putting it on a partial truck compared to doing an LTL during this time of the year because you just can't afford those delays. You also, for more of like the flatbed market, I mean, over the next couple of weeks, right now, you're going to see huge rates out of the Northwest, in particular for Christmas trees, getting those there on time, wreaths, all that stuff. And then at the end of this month, between Christmas till January, oversized shipments in particular can't move in most areas over the weekend, but also during the holidays. So you're going to see a lot of that flatbed market take off after usually it makes a lot of money on trees and things of that nature. So big things I'm watching for: shorter hauls. We brought up the warehousing regional aspect. I think a lot of people are repeating that. So I'm interested in seeing how more of that short haul market, 500, 700 miles, more 500 and under, takes off compared to others. And of course, watching closer to the 15th where those rates start to move as well.
Yeah, will be very interesting. It's great that the sonar product breaks down the length of haul, breaks down all the demand and rejections by length of haul. I mean, earlier in the fall, we saw a lot of that really be the longer haul that moved more, but we'll see if that's trying to reverse itself, like it probably will in the shorter haul side of things. Want to run through a couple of articles that are up on the site in the last couple of minutes. Mark Solomon had an article said "Thinking Inside the Box." Looks like my driveway sometimes with how much my wife orders on Amazon. That picture does, and so we've all had this sort of experience where you order one small thing, comes in a huge box. Sort of why does that happen? Is there a way to reduce some of that efficiency? One of the things that was interesting from one of our earlier shows when we had Chris Moe on, who does consulting for Amazon, marketplace sellers via his company Cartograph, is that the sellers have to move within the Amazon constraints and fit their products into certain size boxes. So, that's something that, shippers are pretty, cognizant of usually is sort of how to get the things in. But he's talking a little bit more about things like having one piece of, lipstick inside of a huge box. And, he brings up that it's a bigger issue for small sellers because the larger sellers can negotiate away some of these fees for dimensional weight pricing. So I thought all those things were interesting. I guess he quotes some companies that have some interesting takes on that. And then want to hit this last article here. supply chain visibility. So this one was contributed content written by Bart from formerly from Project 44 and Gartner. Saw him at the conference. Wealth of experience in the industry, talking about just how critical it is to be able to see your inventory kind of in real time using things like RFID chips, in order to fulfill orders quickly, manage inventory. It really makes you wonder whether there's going to be more goods moved under more of a dynamic pricing model, almost like
Yeah.
there is for sports tickets, where a team's doing well, the prices go up. Weather looks to be horrible, prices go down. But I guess the more you move to that type of business model, the more you can do those.
Yeah, I definitely agree with Bart's assessment on there too. I think I like that. I mean, that's the future of the freight tech in particular. And I think honestly, if you go back to our YouTube page and watch Brad Jacobs talks, that's how he sees the brokerage space evolving into over time too. So definitely one for our readers to check out.
Yeah, so go check out those things, and I want to wish everyone a happy Cyber Monday.
Yeah.